The Global X SuperDividend U.S. ETF, ticker symbol DIV, is one of the highest-yielding dividend ETFs available on the market. It is designed for income-focused investors who prioritize regular cash flow over aggressive capital appreciation. This fund takes a unique approach by targeting the 50 highest-yielding equity securities in the United States, with a strong focus on consistent dividend distribution. If you are looking for an ETF that pays you monthly, offers exposure to U.S. companies, and fits a high-income portfolio, DIV is one of the most prominent candidates. But it comes with caveats that we need to examine carefully. DIV was launched in March of the year 2013 by Global X. The goal was to build a basket of U.S.-based companies that consistently rank among the top yielders. Unlike broader dividend ETFs like VYM or SCHD, DIV focuses almost entirely on maximizing income through high-yield equity exposure. That sounds attractive, but high yield often comes with higher risk, which shows up in the fund's composition, total returns, and price volatility. Let's break down the yield. As of the most recent data, DIV is offering a trailing 12-month yield between 8% and 10%, depending on market conditions. This is far above the average for dividend ETFs. It pays distributions monthly, making it ideal for retirees or investors who want a steady income stream. But this yield is not risk-free. The high payout is often driven by companies with distressed valuations or sectors prone to higher market volatility, such as real estate, energy, and mortgage REITs. Now let's talk about holdings. DIV is equal-weighted, meaning each of its 50 stocks is given roughly the same allocation. The fund typically leans heavily on sectors like utilities, consumer staples, energy infrastructure, and REITs. Some top holdings in the past have included companies like USA Compression Partners, Sabine Royalty Trust, and Vector Group. Many of these are smaller cap or mid-cap companies that do not appear in the S&P 500, which adds more volatility and less brand name stability. You won't find Apple or Microsoft in this portfolio. Instead, you are taking on more specialized bets. The expense ratio for DIV is 0.45% annually. That is higher than broad market ETFs, but in line with other income-focused or specialty funds. The higher fee reflects the more active screening required to target the highest-yielding companies while managing sector balance. Let's go deeper into performance. Since inception in 2013, DIV has delivered inconsistent returns. In bull markets, it tends to underperform because it focuses on yield rather than growth. During downturns, especially in sectors like REITs or energy, it can suffer sharp drawdowns due to its high beta exposure. For example, in the pandemic-driven crash of early 2020, DIV fell more sharply than many dividend peers due to heavy exposure to real estate and small-cap stocks. However, it did recover as monthly yields resumed and certain beaten-down sectors rebounded. From a risk standpoint, investors should be aware that many of the companies inside DIV have unstable earnings or operate in volatile industries. This makes their dividends more susceptible to cuts. While DIV aims for a consistent yield, the actual income it produces can vary. The fund has a history of dividend adjustments, especially during financial stress periods. That is why, despite its super dividend label, sustainability remains a concern for long-term holders. Another factor to consider is price erosion. Because DIV prioritizes high income over price appreciation, the net asset value, or NAV, of the fund tends to decline over time. This is not unusual for high-yield funds. However, it does mean that even as you collect income, your principal value may shrink. It is a trade-off: stable monthly income in exchange for limited capital growth or even gradual capital loss. Compared to other income ETFs, DIV has a very specific use case. For example, JEPI and JPQ generate income using options on large-cap growth stocks. DIV, on the other hand, does not use options but instead screens for high-yield equities directly. Funds like QILD and XYLD use covered call strategies. DIV sticks to the core principle of dividend screening. That makes it easy to understand, but also more vulnerable to economic cycles. Is DIV right for you? That depends on your goals. If your number one priority is receiving a high and steady monthly dividend, and you are comfortable with more volatility and potential long-term price decline, then DIV may be a useful income tool in your portfolio. It is best suited as a high-yield satellite holding, not a core position. And it is especially useful for those in retirement or living off dividends who need consistent monthly payments. Let's rate it with my meter rating. Income potential: 5 out of 5 growth potential, 1 out of 5 volatility, 4 out of 5 sustainability, 2 out of 5 diversification, 3 out of 5 total score, 3 out of 5. If you have any videos you would like me to cover, say it in the comments below and I will break it down in plain English.